fine until that last second. Okay. Thank you, everybody, for showing up. And we're going to talk about option flow for a little while, which is what I've been living for, well, a couple decades, really. Options order flow is what we focus on here at Trade Alert. We have for the last 10 years, and before that I was trading for a couple of different banks. I put some Latin on this cover slide, mostly to sound very, very smart. What that means is that knowledge is power, and with options order flow, that's what we're going for, is making sense of some pretty complicated information using some good tools and some understanding of how the markets work, and using that to basically improve our performance and to find trading strategies, to find trades, and to basically improve any kind of trading. So who we are is a company made up of traders, technologists, we're innovators, we're educators, and we're a service provider. We provide these tools to the primarily the options community, although we do have stock and futures users as well. You guys can hear me, right? Somebody say yes. Okay, thank you, Jars. Thanks, guys. Okay, this is actually me right here in the corner. This is a shot from the Amex floor. This is the XMI pit about 20 years ago. The Amex still kind of exists as part of the NYSE. And I traded on the floors for a few years before moving into the upstairs world, and then into the analytics world, which is what we do now. I'll reply to Gordon. Okay, so this is what we are bringing to to what we do. More than ever before, surviving in these markets is a combination of technology and trading expertise, and it also takes a lot of kind of forward thinking in terms of how to adapt to meet the changing markets. So let's talk about what options order flow is, and I will try to make this as simple as possible. Over here on the left side of your screen, we have our two primary services, which is one is called Option Alert and one is called the Option Scanner. Options order flow is simply buying and selling of calls and puts. Okay, the market is big. There's about 4,000 products with options listed on them. Things you've heard of, like SPY and Q and VIX and VXX, down to cruddy stocks that barely ever trade, but options are listed. In total, there's almost 800,000 individual contracts listed. Okay, so that's all the calls and puts for a series of expirations on the underlying. And options order flow is really basically paying attention to what's going on across this market and making sense of it, trying to figure out what the motivation is when we see trades, when trades are happening. Okay, multi-leg combinations are a big part of the market nowadays. You see here in this trade right here in Boyd was a ratio call spread. So verticals, calendars, it gets a little bit more complicated, but like here's a collar in Microsoft, right? This is the March 87.5, 97.5 risk reversal. It tells you, I mean, our system tells you that somebody sold the put and bought the call. Okay, so that's a very bullish trade as is. Combinations are a big part of the market. They make up about 35% of the daily volume nowadays. Order flow is building of positions over time, right? There's some quick trades, especially because you have weekly options now. And in fact, in some products you have Monday, Wednesday, Friday weekly options. So that certainly is a short-term trade. But then there's also longer dated options, multiple days of trading that are building positions, which you can see, and that's what we're paying attention to as well. And then options order flow is placing bets for earnings, placing bets for economic releases, catalysts. And this obviously, things like M&A announcements get people very excited. And order flow is hedging of other positions. So this really is kind of the meat of what we do, what we try to help people make sense of. Because in this order flow is information, right? And I'm going to show you kind of how we go at that. A couple special things about options order flow. And when I was on the floors working for a market making group, basically the system told us to buy things that were green and sell things that were red. So green here is good and red here is bad. And let's talk about the good things in options order flow, good characteristics. It's directional, okay? At the simplest level, if somebody goes to buy a call, they're looking for the underlying to go up. That's how they're going to make their money. There are kind of other reasons too, but primarily it's keeping it simple. People buy calls when they think the stock's going to go up. They buy puts when they're worried about the stock going down. It's temporal, meaning every option has an expiration, right? It's a wasting asset. So if you buy a call that's 5% out of the money and expires in a month, the only way you're going to make any money on that call is if the stock goes up, certainly within the next month. As you probably have heard, you have time decay working against you. So, the stock has to go up just for that trade position, not to lose money. Options are specific, meaning they have a strike, they have a type, call and put, right? So you have a $100 stock, you could pick a 30-day or a 60-day or a 300-day expiration, and you can pick the strike. And that specificity of the bets that you can put on with options is very important, because we can kind of undo that and say, okay, well, even in complicated trades, you can figure out what scenario makes the trade perform the best, and we use that information. Options are levered instruments, right? You have. Ooh, I just heard the mic go away. Maybe not. You have leverage in out-of-the-money calls, right? And the convexity, which turns an option from a small delta contract into a bigger delta contract as the share moves through the strike. That built-in leverage is what attracts a lot of money into the product. And then the options market is relatively transparent, and what that means is, there's very little OTC. There's no true dark pools in the options world. Basically, when trades happen, you see them print on the market, and in general, you see them print in real time. So that's important, because other products may trade with a bigger OTC sense, and it's hard to make sense of them. On the negative side, or on the challenging side in terms of options order flow, it's a very data-intensive project, right? I said we had about 800,000 contracts to pay attention to. You also have 15 exchanges listing most of those contracts, so you end up with millions of quotes to juggle, to pay, to properly track the order flow. And so it gets very expensive, and it's kind of a one-way street in terms of the technology and the resources required to make sense of options information. It's fragmented. I mentioned there's 15 exchanges. There used to be only 3 or 4, but since 2001, that number quadrupled. It is kind of an esoteric market. You have different exchanges work slightly different ways, so it matters if you see a trade on the Philly versus a trade on the ISE versus a sweep across multiple markets. You have to kind of understand how things work. To me, that is actually one of the best pieces of opportunity in this market, because that's a little bit of a barrier to entry, or a learning curve that kind of keeps the advantage in your court once you understand what's going on. Options are complicated, especially when you get into some of the multi-leg strategies, ratios, calendar spreads, that kind of thing. And in general, it is a challenging market. It's really just, there's a lot more moving parts than a stock, right? You talk about Apple, you have some valuation measures, but it's still one thing. It either goes up or it goes down. Options are you got a lot of moving parts. You got time. You got volatility, which basically impacts how expensive the options are. You have direction, but you have all these things happening at the same time, and so it is challenging to make sense of. But kind of that's what we help people do. So it's good for us. Why does anybody care about options order flow? I will tell you why. My mouse comes back to life. Options order flow tends to be, well, at the simplest level, it's not a lot of dumb people trading options. Certainly not in an institutional sense. A little bit like in the futures world, it's very easy to get blown up if you don't know what you're doing, and because of that leverage and the specificity inherent in an option, it draws very smart money into this market. And for the conspiracy theorists, and the truth is there's plenty of documented cases. It can be very well informed flow, right? So if you, I mean, just think about it. If you do know something's gonna happen, and you have whatever, a couple $100,000 to play with, you could go buy the stock, and maybe using margin account you could get you could leverage yourself up a little bit. But if in general timing and magnitude of something that's going to take place, options are the place you're going to make the most money possible, at the biggest return possible, and that does draw those traders into the options markets. It's timely option order flow, meaning if you do think something's going to happen, you're not going to put that bet down a year early because of the fact that options are a wasting asset. So when you see the options flow, it's usually somebody thinking something's going to happen soon. I guess it's good for the limited attention span that everybody has nowadays. It's easy to replicate what's going on. Okay, but like I said, options are listed instruments. They're relatively liquid, and so basically it's easy to replicate what somebody else is doing. I mean, here's a trade that just happened in whatever this is, the INCY June 87.5 115 call spread. Somebody just sold it for $6.20 on this exchange. If you wanted to go sell a 2-lot, and put $1,200 in the bank, basically making the same bet that this person is making, you could do it, and you're not really going to suffer in pricing. In fact, in a lot of cases, as retail, you'll do better because of kind of the dynamics of price improvement that goes on. Paying attention to option flow is a proven strategy. There's academic papers. There's a bunch. If you Google Pan and Poteshman, that's the one that kind of pops up in the press every once in a while. And the data is relatively old, but I can tell you from experience that there's still plenty of cases where option flow predicts a certain outcome. And then lastly, there's a Wall Street adage, the tail wags the dog. I mean, from the futures side, Danny and Marlon will tell you the stock market is kind of the afterthought, right? Most liquidity is in derivatives, futures, options. You go try to buy $1 million worth of some middle tier stock, and you're going to have a terrible time. But if you go try to buy $1 million worth of options, you're going to find that the liquidity is actually there. So what happens is, a lot of traders go into the options first, and then the banks providing the liquidity in the option space may go out and hedge that position in the underlying. And so what ends up happening is the underlying, which is the dog, ends up moving kind of after the fact. So here's what we look for in terms of options flow. And we're going to find some examples. I'll go quick since we lost some time. The significance, okay? Basically, you need to know relatively what's normal for whatever you're looking at. Apple is one of the most active option classes. Tends to have between 600,000 and 1 million contracts trade on an average day. So you may see 1,000-lot Apple options trade, and how do you know if that makes any sense? We basically just use some intuitive math and say, okay, well, what is this versus normal? How significant is it? And then there's a couple other dimensions you can look at. Say the impact in terms of delta. So not just the contract size, but how many shares it's equivalent to, or how many dollars of premium it is. The directionality of an option trade, or even a group of trades, is an important clue. If somebody buys a whole bunch of calls, like I said, they usually are looking for the stock to go up, so it's a directionally bullish trade. Here's an example. I haven't even looked at this one yet today, but AMC, our system is saying that the flow is directionally bullish on a kind of an aggregate basis, and what that means to me is it's going to be call buyers and put sellers. And actually, you can see out of the top 10 strikes, it looks like 8 of them are calls. The biggest trades, these are nickel call buyers, 50-cent call buyers. We know that based on a couple of different factors, that the simplest level is, did it trade on the bid or the offer? Was it a seller or a buyer? But you can get fancier with that and say, okay, well, that's usually a decent way to go. But in addition to that, was the volatility going up or going down? Okay, because that's an indication of the who's pushing the flow. And then the last piece of that puzzle that we use is a reference theoretical value that's really useful. Even on this little trade down here, a 15 lot of 14 calls, they traded at $1.28. Now that market was kind of wide at 115, 135, right? Mid market would have been 1.25. So you could guess that that's a couple pennies over theoretical value. So it's probably, or over midpoint. But in addition to that, we actually source very good theoretical values from a group in Chicago called FT Options as a third point of reference. And so now you basically can say, well, it traded above the midpoint, it traded above the theoretical, and the volatility change was positive on the day. So in terms of directionality, I know kind of based on what I see that this is directionally bullish, this little trade. Stealth in the options market is something you see nowadays based on the fact that the markets tend to be electronic, or at least about 12 out of the 15. And you can fragment your orders. So if you want to buy 1,000 calls and you want to be kind of sneaky about it, you route those, or you take that 1,000 lot, you split it up, and you shoot it to 15 exchanges, or maybe even do it slowly over time. That's a very different characteristic than, say, calling a broker on an exchange or even at an upstairs shop and saying, hey, where can I buy 1,000 of these? It kind of has a different motivation, right? So what we do is look for these sweep orders that our system puts back together into single trades. So like here's a put buyer in PVG, March 6 puts. Now they traded at 20 cents 1,500 times, but it was not one. It was not one exchange. In fact, it was a whole bunch of smaller pieces. Then the system will give us that data. So these multi-market sweep orders are an important piece of the puzzle. They make up about 40% of the flow. So the intensity of the here's the pieces. So that was 13 trades in 3 milliseconds that made up that 1,500 lot. The only way you're going to know it's a 1,500 lot basically is if you're using our system, because none of the individual legs were bigger than 550 lot. The intensity of an order. These sweeps basically are kind of under the radar. But there's another piece of things, which is basically does a buyer or a seller have to cross the full spread and maybe even go beyond? So basically, buy above the offer to finish up their order. You can see that on basically trades where the price is above the ask. So if we wanted to look for financial names where price is above the offer, this is our system can show that. So like the market on this one was 42, 43 cents in B of A puts, and somebody paid all the way up to 47 cents. So that's a very intense motivation to get that trade done instantly. And then persistence is another piece of the puzzle, we like to see, you see one funky trade, and it tells you somebody did something. If you see kind of repeat action, if it's persistent, especially over multiple days, that tells you somebody's putting a lot of money to work, and you can quantify that money and say, okay, why would somebody bet $800,000 on something happening within the next week or two? So how do you put it to work? Here's a couple of trades, and I'll even show you one that I did yesterday. Short-term scalping of the stock is doable, both directions. So meaning, you see a big aggressive call buyer, the stock's going to run most of the time. You can try to get ahead of that and make a trade. You can also kind of see a situation where the stock has spiked and fade it. Okay, that's the bottom one on this list is basically fading kind of dumb activity. A smart money bias is basically if we see persistent activity in a name, call buying day after day, building up, then it tells me that that a position is being built. It can be a large position, which means somebody is committing capital to a scenario, and in that case, that's not a that's not a day trade. That's a longer term position, but it's a bias that I would put on a holding. Anticipating an exit. Basically, when you track the option order flow, you'll see somebody get into something. You can basically watch, whether or not the situation they're looking for happens, and then you also can kind of anticipate them changing their mind and saying, okay, well, either I've made my money and now I'm going to get out, or I've lost half my money and now I'm going to get out. And because you kind of know that information is that motivation is there, you can kind of be in the right spot. And you can even leave a bid out there if somebody's going to be dumping some position, and you can just pick up options at unusually low prices or sell them at unusually high prices. Sector rotation we see mostly in the ETFs, but when you see a lot of money going into, say, energy and technology, you kind of know that options are being used for their liquidity and leverage, and that's where the money's going. So it's not a bad way to say, okay, I see, a lot of money going into industrials and, consumer goods, and it helps you kind of shape your own position. So that's those are the trades that I do. I would actually say, the beauty of what we do is we provide a tool, not recommendations, and there's people smarter than I am out there finding other ways to use this information. I'll show you one trade that I did yesterday just to show you that kind of what I was looking at, and this is the only trade I did yesterday, and it did make money. So I'm not cherry picking, although I have my losing trades too. This is Domino's Pizza yesterday, which I'm going to stop our little scanner here, and we're going to pull up yesterday's trades. Now, I had earnings the day before, so the stock opened up down pretty hard post earnings, and early in the day, actually right here, oh, it's gone. Let me get back up here. I saw this, not only a decent size call buyer as the shares were getting hit, but it also was a surprisingly juicy trade in terms of the price above theoretical. Okay, so this is yesterday, and we can even look at 1 minute. 1 minute trades, say ended at 12:30, so we get a good graph. So this trade here at $5 is what caught my eye. Okay, so it's 1,000 of these April 230 calls, trading for $5. 17 minutes into the day, when stock was 214. Okay, these are 230s. So these were $15 out of the money calls. What happened here? Didn't get my start time. Sorry about that. Now I know it was a buyer kind of definitively a buyer because of the fact that it traded 460. The value was 461, and the buyer had to pay $5. Okay, you can see this was a post-earnings, pretty early, terrible market. 255 bid at 670. It was a garbage market, which is why you need to have a theoretical reference for, especially once you get away from, SPY and Apple. This little bar right here at 947, this is this trade. Okay, so you can see I knew it was significant just based on, the average daily volume in Domino's was only 3,000 contracts. Okay, so when I saw that trade, I was like, okay, that's somebody, putting a decent amount of money. That's $500,000, 1,000 times $5, into a position that is relatively longer dated. But basically, they were buying the bottom. Now, the reason I didn't go touch any options is because of that market that was 255 at 670. It's basically untradeable. And so what I did is I just bought some stock. You can even see the time is. Let's see, this one was at 947.23. I bought the stock at 947.47. So 20 seconds later, I paid $214.80 for the stock. So where was it? I keep losing it here. Sorry, $214.80. So the stock had already gone up 60 cents. And about 45 minutes later, almost an hour later, I got out for almost $2 over. So, in terms of short-term scalps, I mean, that $5 call buyer said something to me, which is somebody with some serious money is not afraid of this stock getting hammered any worse than it already is. So I bought it, flipped out of the stock, and made some money. And as every trader knows, you want to combine this with money management and as many other kind of intelligent parameters as you can. I'm actually going to hand you over to my associate Harmeet Goindi, who is our resident expert on theoretical or on on everything, but on technicals, because we integrate a decent amount of technicals into our approach in one of our products, and I think it might be interesting to you. Our contact info will be at the end of this. Thank you for your time, and feel free to reach out to us if you want to try our system live or ask any questions. Let me see if I can figure out how to hand it over to Harmeet. Thank you, guys.
Hello? Yeah, I guess, yeah, perfect. Sorry about that. Let me share my screen. Hi, can you hear me? All right then. Sorry about that. I think we had the same microphone issue. So as Henry pointed out, that we also oftentimes what has happened is a lot of traders have come to us and said that options are nice and good, but they're too complicated, and sometimes the risk there are risks that we don't know how to hedge, the complicated Greek risk like gamma and vega, and so but I only trade stocks. So how do I go about it? Like how can I use your product? And to sort of answer that question, what I usually say is options are very important if you want to understand what the market is doing. They are more efficient in that whenever a signal that comes in the market about any particular stock, it's first manifested in option market and then it moves to stock market. So what I would recommend is you start watching option market and option flow using our tools and other tools, and then using that information trade your stocks. So I'm going to use one example right here, and then there are more examples that I'll be happy to talk to you about it at later stage, or you can feel free to email us or call us. But one thing I'm sure you all are using a lot in your trading strategies, technical analysis, right? To give a brief sort of cliff notes on it, it's basically the study of finding patterns, right? The earlier form of technical analysis were chartist and Dow theory, and so on and so forth. Uh, Sorry, give me a second. Let me just okay. Um, Sorry about that, guys. All right. So basically the idea, and then it has moved on to what we call the, co-integration models, high frequency trading, and right now deep learning and artificial intelligence. But they all basically follow the same principle. That is that the efficient market hypothesis does not hold, at least in short term, and then people are not rational. And so let's make money trying to leverage that particular inefficiency. And it's not some mumbo jumbo thing. It's basically there are three, four scientists who have won Nobel Prize in behavioral economics, and then something that has deep rooted science behind it. All right. And so what we are going to do today is do the simplest one, the moving average, and then we will I'll show you how to use option analysis along with moving average. So this is our website where we do most of the technical stuff. It's called whatstrading.com. It's part of TraderAlert. You can come and take a look. And in this place, we have charts, of course, and I'm going to show you a chart of Apple, and then maybe talk about a little bit about technical analysis. So moving averages, right? What are moving averages? Basically, they are the average of stock price for past few days, right? And the way we do moving average as opposed to normal averages, we give more weightage to the current stock price. So a basic formula of moving average is today's price times a weight, which is a small weight, plus yesterday's price times a bigger weight, right? But the weights are such that the current price gets higher weightage than the uh, older weights. And one beauty about moving average is that it has all the stock price information in it, right? Starting from the day of inception. That's the way it's constructed. Okay. Um, so what's the advantage of moving average? Well, it smooths things out. So if you look at this green line, right? This green line is the price of Apple stock, right? And it's very jaggedy, and it's very hard to make sense out of it, right? You see this. But well, if you look at the blue line, the blue dotted line, and the red dotted line, they are the moving average line, and they give you a nice trend. So if you look at the red line, you can say, wow, yeah, Apple went up, then it was sort of going down, now it's going up, and that's the long trend, right? And the blue line is a short trend, right? And the way you do it is this is a EMA over 50 days versus EMA over 200 days, right? And what people do is whenever these two lines cross over, right? That's when that's basically an indication of market trend changing, right? And so when the short-term trend, which is a blue line, crosses the long-term trend downside, you have what is known as a death cross. So it's an indication that markets are becoming more bearish, and vice versa. When the short-term EMA crosses the long-term EMA on the positive side, you have a bullish indicator called the golden cross. And oftentimes people trade on it, right? And we show that in our charts, and you can look into look you will get a nice little golden cross when that happens, and you can trade on it. But they don't always work, and I will show you examples why they don't work and how you can use options to figure out. Right. So then, let's talk about USA because it's very interesting things that have happened in the past. But before that, I want to also talk about one thing known as percentiles, right? Um, so what we do is, I think that's something that we all should sort of keep in mind, ranking the volumes and other metrics in stock market, right? But what I mean by that is, let's say if I tell you the number of calls traded in IBM today were 10,000. For someone who has no idea about what IBM calls trade at and how many trade in a day, they would not know whether it's a large number or a low number, right? And so it's better to normalize it, right? So I would say that the percentile of IBM call option today was 83, which means that in past 1 year, 83% of the times the call volume has been lower than this, right? And that is a big that tells you a lot about where the market is heading. Um, Let me just give you a simple example. On when the whole market meltdown happened last week, right? If you look at Apple puts, it was 226,000, right? That's a big number, right? And but those who don't know about Apple would not know what that means. Is it big? Is it not big? And so then you look at the percentile. It's 85 percentile, which means that only 15 times in last 100 days, right? Or we do it over years, so 15% of times in last year, puts have been traded more than 226,000, right? And so this means that today is a very high put volume day, right? But one thing to be aware of is it's not just the put value, the number of puts traded that's important. It's how it compares to its peers, right? So when you click on this value, you can see three sort of rows here, three sort of columns here. The red one tells you about the stock itself, the Apple. The gray one is the sector, and the orange one is the whole market, right? So now puts, right, they look very high, the calls look very high, but if you look at the market, they're not really high. XLK was more than Apple, right? And so while this might look like a significant day or maybe some information is being, you could try to figure out what information is being conveyed by these options, the reality is nothing is, because market was just crazy. And so you basically ignore these blips, these huge numbers, right? On the other hand, there are days when these numbers are more than SPY, and that's when you need to take care of, look out. And I'm going to give you an example of that. So coming back to USO, right? Let's look at this golden cross. This is when the short-term 50-day moving average went over the 200-day moving average, right? And so if people would think it's a bullish indicator. Should we buy? Should we not? We have no idea. So what we do is we click here, and when you click on that cross, you'll see what happened on that day, right? And what you could do is you can hover over this value, and what you're going to see is various percentiles, right? So if you look at puts of USO, they are low, and put and call percentile is high, which means that while the whole sector has more puts being traded than calls, in case of USO, more calls were being traded than puts, right? So that's a bullish indicator. Also, if you look at put call ratio, it's at lower end, right? And the whole sector and SPY is at 80s, whereas USO is at 35, right? So this is a bullish indicator. And so the stock market sort of agrees with you, and maybe you should go and buy. And then, you would have done good if you did that, right? On the other end, there is this bearish indicator, right? A death cross, right? And you probably would have thought about shorting it. But if you look at the option market, right? And the reason is, you see a lot of puts being traded. So if you look at option market, you would think, should I not? And then when you look into the details, yes, there are a lot of puts traded, but so were a lot of calls, right? If you look at calls and puts, they're almost the same, right? Generally, puts are more than calls, but in this case, they are equal. And and the put call ratio is less than the stock market or the sector. So maybe, I mean, in if you just look at numbers, raw numbers, it looks bearish, but when you compare to the market itself, this is not bearish. It's actually very bullish, and so you should probably have not shorted the market, and you would have done well if you didn't, right? And so that's how option can sort of give you an extra oomph over your technical analysis. A quick note for those of you who use MACD, right? So if you look for USO, this is a very nice example on June 28th, right? So MACD turns up, it crosses the signal line, and so you would think it's a good signal, right? And let's see what the stock market is saying. And yes, you look, calls are more than puts. Put call ratio is also low. So this is a bullish indicator. So in this case, your your option markets are supporting your technical analysis, and the stocks will go up. So these are a couple of ways you can use our charts to sort of enhance your trading strategies that are based on technicals. And we also put out some commentaries here to give you what's happening in the market in technology, or you can choose a sector. You can go to all securities, and you can there are some commentaries by Henry and myself. And there are some screeners if you're interested in those. I mean, there's a lot of interest about borrow. There are a lot of interesting things here. Um, Feel free to call us or send us a mail if you have more questions. Um, and here is a plug. So we have a special offer for you guys. It's whatstrading.com/web promo, and use the coupon TOPSTEP to get 50% off. And you can reach out to us at support@whatstrading.com or support@tradealert.com. And also for those of us who are going to be at Traders Expo this weekend, we would be there. We would be presenting on Monday, and we would have a booth there, so you can come and say hi to us. It's free, so those of you who are in New York, you want to come, you can just go to Traders Expo and attend for free. and we would be happy to meet with you and talk to you. Thank you very much. And if you have any questions, I guess we have 2 minutes to answer them. Oh, this looks weird. I guess there are none. Well, if you have any questions, feel free to reach out to us at support@tradealert.com. Um, Thank you very much.